What's up everyone? I hope you guys will be having a wonderful time. I'm back with a new lecture, and in this lecture I will teach you all the important ICT concepts that you need to be a good trader. I will only teach you the concepts that actually works. I won't use difficult terminologies like ICT uses in his lectures because you don't need fancy terminologies to be a good trader. All you need to know is how you can execute your trade. And I don't use fancy thumbnails like other YouTubers, but the content I'm going to share with you is better than every other YouTuber because first I will teach you the strategy, the basic concepts, and then I will show you how you could have caught this big move on Bitcoin, okay, by using this simple strategy. And after watching this strategy, you would know how easy it was to catch this move from this point to this point. You can use this strategy on any pair like on forex, indices, but I'm using it on Bitcoin because recently this big move happened on Bitcoin, okay? And the strategy is same for all the other pairs, like if it's forex, if it's indices, it works the same on all the pairs. And I will show you only the bullish example, okay? And the concepts will be the same for the bearish case. So if you understand how you can use it in this case, you will automatically know how you can use it on bearish case, like from top to bottom. So let me start the lecture. I will start from the basics, okay? What is order block? This is the most important thing or the base of this strategy, okay? You have to understand order block and breaker block. I have teach you again and again this concept of order block. So order block is simple. First I will teach you the bullish order block because I'm going to teach you the bullish move on Bitcoin. So I will use the bullish order block. Let me color it red. So let's suppose the price is going down, okay? Like this is a bearish candle, the price is going down. Let's suppose this is a 1 hour candle as I'm using the 1 hour time frame. So we got a bearish candle on Bitcoin, then we got another bearish candle, okay? And let's suppose we got another candle which was bullish and it closed above this bearish candle, okay? There was some bearish candle, then we got a bullish candle, and then we got another candle. Like it can either be bullish or bearish, okay? So you can see two bearish candles and then two bullish candles. Now you can see we have to ignore this candle. Like if there are other candles like this, you have to ignore all of them. You have to study these three candles. Like this candle at the bottom, you can see this has made the bottom. So start from this candle. This was the bearish candle and it made the bottom. Then we got another candle, okay, and this closed above this candle, okay? You can see this candle closed above this one. And then you have to study the third candle. Why the third candle is important? Because you have to find a gap between the top of this candle and the bottom of this candle, this gap, okay? This is called the fair value gap. So when you get this fair value gap, I will color it gray. So when you get this bearish candle and then a bullish candle and then a third candle, and you find this gap between the first and the third candle, then this structure, this is called order block, and this is a bullish order block. Let me show you a bearish order block too. Let's suppose the price was going up like this, okay? Then we got some more candle, another candle which also went up, and let's suppose another candle formed and it closed below the previous one. This is a bearish candle. Then another candle formed. Let's suppose in this case it's a bullish candle, the third candle. So in this case we have to again study these three candles. The candle which made the top, in this case this candle made the top, okay? So start from this one. So you can see a bullish candle, then another candle which closed below this, and now you have to study the third candle, and now there is a gap, okay, between the bottom of this candle and the top of this candle, and this gap is called fair value gap. You can name it only a gap, okay? You don't need terminologies. So this is a fair value gap. Now when you get such structure, it becomes a bearish order block. Now what happens in these structures is that the price goes up, and then when it retests this gap or it retests the top of this candle like this, let me show you, let me draw it again. When the price comes down, it gets a reaction and the price goes up. But this does not happen every time. Like there are specific structures which forms, and then when it retests these areas, you will get a reaction like this. In this case, you will get a bullish reaction, and in this case, you will get a bearish reaction and the price will go down. But this does not happen every time. There are specific points in the chart where you will get these structures and then you will get the reaction, and I will teach you that in a moment. Now you understand what is a bearish order block and bullish order block. Now you have to understand the concept of pullback. Let's suppose the price is going up, like I'm going to teach you the bullish case, so we will discuss the bullish case only. Let's suppose the price was going up like this, okay? So we will draw this line like this. The price is going up, okay? Then we got another candle. The price was going up, so we will extend this line, okay? The price is still going up. Then we get another candle, let's suppose, and still the price was going up like this. Then we got a bearish candle, and you can see this candle came below this one. So in this case, what you will do is you will draw a line, because this candle came down and closed below it, or just a wick will work, okay? If it just wicks below this candle, you will draw this line, and we call it a pullback, okay? So we got a pullback here. Let's suppose we got another candle, again it closed below this previous, so it's going down. Now let's suppose we get another candle, in this case bullish candle, and now the price is going up. So what you will do is you will draw another line, and now the price is going up. So you got this pullback, and again you got this pump, and you can see this is a bullish trend. This is what you see in a bullish market. Let's suppose we got a bearish candle, we got again a pullback, and the price comes down. Then you got another candle, bullish candle, and again the price goes up. So this is a common case. Like you see this in every bullish market. What happens is that the price goes up, then goes down, then goes up, goes down, and the market moves like this. And this is how you have to draw it, okay? This is called a single candle pullback. Like even if a single candle closes below the previous candle, you have to draw this pullback. Now at some points what happens is that the price goes up like this, okay? It makes higher highs, higher lows, and then what happens is that the price makes a lower low, and it sweeps the last low which was made before sweeping the high. You can see in this case it swept the last low that was made before sweeping this high. So you can see this, and then again the price goes up and close above this point. So in this case this sweep is called inducement, okay? Now again, you don't need these terminologies, you don't have to know this, but this is called IDM. You can name it anything, okay? You can call it a sweep. I will call it inducement. And now you can see this has closed above this point, so we will call it a break of structure, okay? This is called the break of structure. This is called inducement. This is called the break of structure. Now when this happens, then the market retests, and this is where you can get your entry, okay? This is where you can get your entry, and this happens every now and then. Like the market keeps moving up, then an inducement forms, then a break of structure forms, then the market retests and then goes up. Then again market goes up, inducement, break of structure, retest, and then the market pumps. But at this point there are specific structures which you have to use to get your entry. You can either use the order blocks or breaker blocks. Now what is a breaker block? So as I told you, this is an order block, like a bullish order block. The market goes down, okay? then the market goes up, we get a fair value gap. So this area becomes bullish order block and the market goes up after retesting this area. Now sometimes what happens is that the market don't go up from this area, so in that case the market will go down, close below this, and in this case this area will become a breaker block. So now the market will get a rejection. This area will become a breaker block. So when your order block becomes invalidated, okay, it don't get the respect, okay, the market don't pump from here and instead it closes below it. This order block becomes a breaker block and it will give a reaction in the opposite direction. So when the market retests this area, this is where you have to find a order block or breaker block, and from that order block or breaker block you will get a reaction and the market will pump. Now if you get an entry at this point, okay, you will have to place a stop loss below this point, okay, like 5 to 4 pips below this point, because you can see we got an inducement, then we got a break of structure. Now this becomes a valid low and the market will respect this area. So sometimes the market pumps from an order block at this point, and sometimes the market just sweeps this area, a small sweep, okay, and then the market goes down, okay, just wicks below this and closes above it, and then it starts going up. So either it will pump from an order block like in this area, or either it sweeps this low, okay, don't close below this low, and then it starts pumping. Now I will show you these examples on the Bitcoin chart. Let me remove all these drawings and I will teach you how this structure forms. Like you can see, this the market is in a bullish trend, so we will start from here and we will study those structures here. There are some more things to this and I will teach you those points here. Like here you can see that this is a big candle and then you got another candle, but you can see this candle has not gone above or below this point. So in this case you won't extend the line because this is a single candle. This candle has not gone above this candle, so we will just draw a straight line, and then the next candle went above this one, so we will extend the line. Now again these two candles, these have not gone below or above this candle, so we won't count these two candles and we won't count this candle. So the market went up and then again this candle formed and it closed below this, so we will count this one. Now again we won't count these 3 or 4 candles because these 4 candles have not gone above or below this, so these candles we won't count this, okay, you have to understand it. Now I will start drawing these pullbacks. Let's suppose the market went up, okay, then we got a pullback, again the market went up, you can see it is a bullish trend, and then again the market went up, came down. You can see the market keeps trending in the upward direction, okay, it's not giving you any pullback, okay, it's just going up in the upward direction, so it's not giving us any entry. So still we will wait for any entry. Then again the market is going up, okay, there is a pullback, again the market went up and a pullback. So here let me remove this. Here you can see that the market went up here, but we won't count these 2 candles because you can see these 2 candles have not gone above this one, so we won't draw a pullback like this here because these 2 candles are not valid. Instead the market went up and then we got a pullback. So still the market is trending, okay, it's not giving us any inducement. But here if you see, the market went up, it came down, then it made a high, then it came down, you can see, then a high, and now we got an inducement here. You can see this was the last low that was made before sweeping this high, so this is an inducement, okay, we got an inducement here. I will increase curve. So the market went up, came down, again made another high, and now what happened? we got an inducement. What is an inducement? When the market sweeps the last low that was made before sweeping this high. So once you get an inducement, you have to wait for a close above this last high, okay? And here you can see that the market, it went up, it closed above it. Now, as I told you earlier, then you have to look for entries in this area. So now you will look for any order blocks or breaker blocks in this area. So let me show you the order block or breaker block here. You can see this is a candle, okay? It made the high, a bullish candle. Then we got another candle and it closed below it, okay? And then another candle, and you can see we got a gap here, a fair value gap. We got a gap here. So this becomes a bearish order block, but you can see that we didn't get a reaction, a bearish reaction, and instead the market went up and it closed above this point. So now this becomes a breaker block. This was a bearish order block, but now the market has closed above it. So now we will use this point for an entry, okay? Why we will use this point? Because we have got a break of structure, and now there is a bullish breaker block in this area. So when the market closes above this and we get a break of structure and then it retests this area, this is where you will get your entry, and you will place your stop loss below the last swing low, 5 or 10 pips below here, and you will target the highs, okay? You can use 2 RR or 2.4 RR, okay? Let's suppose this was your target of 2 RR, or you can use 4 RR also. Now I will show you some more examples. The market again, it went up, okay? It gave a pullback here, then again it went up, gave this pullback, again it went up, and here we got an inducement. Why? Because this was the last low that was made before sweeping this high, and we got a sweep of this area, so we got an inducement here. Now we will wait for a close above this area because this was the high. So after inducement, when the market closes above here, then we will look for entries, and you can see in this area here we got a close above this point. Now what you have to do is you have to wait for a retest of this area, and in this area you will have to look for some order blocks. So you can see this was an order block. You can see a bearish candle, a down closing candle, then followed by a bullish candle and another third candle, and you can see there was a gap between the first and the third candle. So this area becomes a bullish order block, and we have got a break of structure here. So when you get a break of structure and then you have an order block here, so what will happen is that the market will go down and test this order block, and this is where you will get your entry. In this case, the stop loss is much tighter. This will be your order, okay, the buy order. You will place your stop loss below this swing low, okay, and again you can go for at least 2 RR, okay. When the high, you can see here the high was very near, so we got our profits at 2 RR, okay. Like our target is usually the last swing high, so in this case this will be our target. So in this case you don't need to put 2 RR target. In this case you will target at least this high. So you can see here you got 5.6 RR. So when this high is near to your entry, then you can go for 2.4 RR, and in case it's far away, then you don't have to use 2.4 RR. You have to target this point, and in this case the risk to reward ratio will be much bigger. Now I will show you another example. Okay, you can see the price went up, okay, pullback, again it went up, and then we got an inducement. This was the last low that was made before sweeping this high, so we got an inducement, and then we got a break of structure, okay. This was the break of structure. So now if the market retest this area, in this case there is no bullish order block on the 1 hour time frame. So in such case, when there are few candles, you have to shift to smaller time frame like 15 minutes, okay, or 30 minutes, and then you can look for entries. So I'm sure there was any bullish order block on the smaller time frame. Let's suppose it was in this area. So again you will get your entry here, and you can target this swing high, the last swing high, and the market will sweep the last swing high. Okay, it will sweep this swing high. This was another entry. Okay, so let me show you another example, like why the market retested this area and then it pumped. So if I shift to the 4-hour time frame, you will see some interesting thing here. Okay, so I will show you an interesting thing here. I will remove all the drawings first. Okay, so you can see the market went up, gave a pullback, again it went up, gave a pullback, no IDM. Okay, then again a high was made. Okay, and then a pullback as this candle closed below this one, came below this one, so this is a pullback. Then again the market went up, gave a pullback, went up, gave a pullback, went up, still no IDM. And in this case you got an IDM as it swept the last swing lows that were made before sweeping the highs. So you got an IDM, and now if the market closes above this point, the last this swing high, this is called the breakout structure. As you can see, the market closed above this point on the 4-hour. So now what you will do is you will have to get an entry on retest. So now you will look for any bullish order blocks in this area on any time frame, like 4-hour, 1 hour, 30 minutes or 15 minutes. So if I shift to the 1-hour time frame, let me see if there are any bullish order blocks in this area. So not much here on the 1-hour time frame. I will shift to the 30-minute time frame, and let's see if there are any bullish order blocks in this area. You can see there is one order block here. Okay, this is an order block, so you can expect a reaction from this area. And you can see the market came down. Okay, as I told you earlier, sometimes it gets a reaction from the order block and sometimes it sweeps this low and then goes up. So in this case it swept this order block but didn't close below it, and you can see it got this big reaction from this point to this point. Okay, now this is a big wick. So when the market goes up in such a fast manner, what happens is that the market, it comes down, okay, tests the 0.5 fib level of this wick. Let me show you. This is a big wick, so the market will come down and go below the 0.5 fib level of this wick, and something like this, it will come down and then it will go up and sweep this area. So in such case you will have to buy below this 0.5 fib level, like in this area. Okay, you will have to place your stop loss somewhat below here, and it will close above. Now what will be the invalidations of these trades? If the market comes down and it closes below this point, below this line on the 4-hour time frame, this will be your invalidation. Okay, if the market comes down and it closes below it, now this will be your invalidation and the market will no more be bullish. And what will happen is the market will then go up, retest this bearish order block and then come down. Okay, this will be your invalidation point. Like if I shift to 1-hour time frame, let me show you those old examples again. As I told you here, this was our entry point, this bullish breaker block. In such case, had the market come down, okay, and closed below this point, this would be your invalidation. In this case, you will cancel the trade. Okay, you will close the trade, and then what will happen is the market will go up and retest the highs and go down. Okay, so the invalidation is a close below the inducement point. If the market closes below the inducement point, this will be your invalidation. So right now I am still bullish on Bitcoin. Okay, I am still bullish on Bitcoin, and if it closes below the invalidation point, that will be, if it closes below this point on the 4-hour time frame, below this point, this will be the invalidation. Okay, in that case what will happen is the market will come down and then go up and boom. but I am not expecting that. I will get an entry once the price comes below the 0.5 fib level of this wick, and I will look for these highs, okay? And then if it closes below here, I will turn myself into a bear, and then I will look for shorts in this area. So this is how this strategy works. You can see that I didn't use any fancy terminologies. You just need 2 or 3 concepts like order block, breaker block, inducement, and breakout structure. Okay, if you know these things, you can get your entries and you can catch all these big moves.